We're always told a market crash is a total disaster. But what if the numbers tell a different story? We're going to dig into the data and see who really wins when the market takes a dive.
You've heard it, right? It's everywhere, on the news, in your social feeds, this constant drumbeat warning that a crash is just around the corner. And all that noise, well, it's designed to make you feel uncertain, maybe even a little scared.
But here's a thought. What if we've been looking at this all wrong? What if a market dip isn't something to fear, but the exact opportunity you've been waiting for? A moment to be strategic when everyone else is panicking. That's what we're breaking down today.
See, when things get volatile, it really all boils down to two very different ways of thinking. And how you react in those moments, well, that's what separates the winners from the losers.
And you can see the difference right here. On the left, you've got short-term trading. It's all about reacting to the noise, trying to guess the market's next move. You often just end up racking up fees and taking on a ton of risk. But on the right, you have long-term investing. This isn't about reacting, it's about having a plan. It sees a market dip as a sale, a chance to buy great companies for cheaper, and just wait for the recovery.
So here's the bottom line. The goal isn't to have a crystal ball and predict the future. It's about being prepared, having a plan, and being ready to act when everyone else is running for the exits.
Okay, so let's make this real. We're going to look at a case study of a huge, well-known company on the FTSE 100, the banking giant HSBC. This is where you can see the strategy in action.
So here's a chart of HSBC's performance. And yeah, you can see the bumps, the dips, the volatility along the way. But for anyone who zoomed out and looked at the big picture, the long-term trend is pretty clear.
All right, now let's get into the actual numbers behind that chart. This is where the story of opportunity really starts to come into focus. Over the last 5 years, if you include the dividends, HSBC shares are up a massive 175%. Just let that sink in. That's the power of sticking with a solid company through the ups and downs.
And this isn't just ancient history either. The momentum has been strong lately. In just the past year, it's climbed another 45%, so it's got both long-term and recent strength.
But then, look at this. Just last week, the price dropped 5.7%. Now, for some people, that's a panic button. But for an investor with a plan, that is the signal.
So what did that little dip actually do? Well, it pushed its price-to-earnings ratio, which is just a simple way of measuring how expensive a stock is, down below 11. And generally, a lower PE can be a huge sign that a stock is on sale.
And that's it. That's the whole idea right there. The short-term price drop isn't the problem, it's the opportunity. It's the green light to potentially buy a great company for a better price than you could have just a few days ago.
Okay, but let's be real. It's never that simple. Every investment has risks, and you have to look at both sides of the coin before you do anything.
So what are the potential bumps in the road for a company like HSBC? You've got a slowing economy in China that they're exposed to, you've got all the geopolitical stuff happening, and then there's this big $1.1 billion legal charge that definitely hit their profits. These are real things to consider.
So yeah, those risks are real. No doubt about it. But for a long-term investor, the thinking is different. They see those risks, but they also see the chance to buy a solid company at a discount because of that short-term fear. That could turn out to be a very smart move down the road.
Okay, so that's the theory, that's the case study. The big question is, how do you actually do this yourself? How do you get on the winning side of the next downturn? It's actually a pretty straightforward 3-step plan. Step 1, do the work now. Build a watch list of high-quality companies you actually want to own for the long haul. Step 2, wait. Be patient. The dips will come. And step 3, when they do, pull the trigger. Buy those companies you love at a discount, and then just hold on for the recovery.
So let's just wrap it up with this one idea. The next market crash isn't a question of if, it's a question of when. And all this data shows us that the winners aren't the ones who can predict the future. They're the ones who are prepared for it. So the real question isn't when will the market crash, it's is your watch list ready?